Good morning, everybody. It is Tuesday, May 27th. Now that the holidays are over and school is out, we'll be back to our daily sessions. Before we get started today, as always, we'll start off with a reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, we'll go through our normal charts and kind of dissect the market here, and then give you some levels and a reminder at the end. So first thing, with new data, we always take a look. Every Friday, we get our COT report, although this week it'll be delayed because of the holiday on Monday. But we see the commercials are still long the S&P. They did sell about 15 to 18% of their position last week, and but still net long, and they're still over where they had acquired that position. Bitcoin is still at a max long as well as we push towards new all-time highs last week, and we still have plenty of product to distribute for a continued push. And so that's what we're reading into this. Again, the house always will win this on the long game, and we can see this on our chart here when commercials were net short, and again they can withstand all of this. They went max short, covered it all, and then now they are going long as a buy the dip is playing out. Now, the big signal here that we want to pay attention to in terms of risk, because we always want to assess things through the window and through the lens of risk management, is that there's not a lot of open interest. So that tells us that while they are long, uh, and this is their longest they've been in the last year, we don't have the same kind of open interest that we had back in 2023. So we want to be prepared that these things can shift a lot quicker than they have in the past. And we'll also now look to credit spreads. We always go here on the high yield end. A big level on high yield is going to be 3.5 on the options adjusted. And that typically signals that there's credit pressure. We have recessionary credit risk when we see the high yield getting above the HYG. We saw that in 2022. Again, when the high yield breaks out, as we saw in 2022, that starts the downside before we get the recessionary signals and the manufacturing recession that we saw with PMI and everything except for the Mag 7 stocks. And then once that credit risk gets taken out, then we can see the market start to have a sustained rally. We saw it come back in August of last year, and then recently here in February, March, and April. So this is what we're going to be watching in the coming days and weeks. We check this every day and intraday, but for those of you just following along, this will be what we pay attention to in the coming sessions. And on to bond volatility. Nothing is really happening in bond volatility. The move index did drop to the point where volatility broke out. Again, it was too low, so now we're seeing it bounce a little bit. But we are just range bound, and so that tells us that all of this concern at the moment on the bond market is not signaling extreme follow through into equities unless we get the move index starting to break out over 110 again. Then we will watch there. And on to multi-asset volatility, we came in and out of the VIX expiration last week, which again is another business cycle closing and a reopening of a new business cycle. And we saw volatility come back in as the ball underwater has now popped back up. Again, this is still saying the bounce that we've had in equities is risky, but we don't have the positioning yet for a significant downturn. We don't have enough people, enough cash into the market yet to see that sustained downside move. But we are starting to get there on some of our metrics. We are around 70%. We still have 20 to 30% to go before we'll really see that signal that a market top could be in. So that doesn't mean that there couldn't be. What we would watch for if this is all the positioning we're going to get is the VIX to break out over 25 and the VIXN to break out over 30, 30 to 32. Otherwise, on the downside on volatility, we want to watch the 18 to 20 mark on the VIX, as that will be where we bottomed previously, and then what we'll be looking for again to see if it can continue lower and break that, then we look for a much more sustained rally. That will also be a signal that the business environment is changing. What the market makers have to do to balance out their books changes and shifts and will be much more supportive. For now, we are much larger chop, wider ranges, and great for us day traders. But know what you need to watch because when certain things change, the business environment changes drastically, and you want to know what these are so you can adapt accordingly. Now on to insurance in the market. We do have several catalysts this week that will require insurance, including GDP, Nvidia earnings, PCE, consumer confidence, and consumer sentiment. And then next week we start our jobs reports, and the following week we get all of our inflation reports. So over the next few weeks we should see this begin to rise, but right now we're getting told that everybody's complacent. Nobody sees any risk right now. Nobody wants insurance. And so the move up from Memorial Day and Globex is to make the insurance cheaper and appear more attractive, as we know that people have to buy, and then we can sell the market down uh, as people buy insurance. And then once that is done and that demand is gone for the insurance, then the market rallies back up. Um, Remember that outside of us day traders, there is large money that is being handled. And in the markets, if you don't insure that and protect on that, you actually can lose a lot more by not having that. So it's a small cost, just like your car insurance. It's a cost of doing business. Um, but the insurance providers in the market, like your Geicos and Progressives for your car insurance, the ones that provide that in the stock market, do the same thing. They, charge a higher premium when they can, and then they do what they can to make sure that the market doesn't have a crash, that it doesn't have certain aspects playing out that really exposes them to too much risk. So that's what we watch for here. So we'll look for these to go from the green up to the upper edge of the yellow and really into the red zone. And you can go back to any old videos. We've gone over this washing machine before. And for our students, we do have a real-time tool to monitor this as well. So if you have any questions on that, please let us know in our rooms. And otherwise, we'll provide these updates daily for our morning videos. Now, on to some other risk aspects in the market. We mentioned this briefly a couple of days ago that the pricing in the market is what we can watch, and the pricing was starting to get skewed. That we were seeing that there was a lot of opportunity on the downside. And so again, after the VIX expired. Again, business cycle ends, business cycles change. We then begin to see the yellow line start to cross over zero, which tells us that now pricing is going to start increasing. And that means that our volatility is going to start changing. And with that occurring, we see the downside potential. And we've seen this time and again when we get the blue bars first beginning to cross over our zero line here, we see bigger downside potential. And we saw that again. So we can monitor this. We saw this coming last week that the downside was highly likely. One of our educators posted in the room a pattern as well, but we saw the move coming from 58.94 back down to 57.63. There are some key references there, and this is one of the big signals we look for in terms of a trend day. So if you can understand what has to change in the market, remember that trend days, sideways days, consolidation, balancing, all are functions of the business. And so if you can identify just the same way you would with a retail store when their pricing is off and you can buy something cheaper, as people do with Costco and others, and then go and resell it on eBay, or when a company or a retailer is overpriced and is likely not going to make sales and then go out of business. It's the same concept here. We're looking at how the pricing is set up for the overall market, and that's really all that we're paying attention to here, and it gives us some good edges. Now, in terms of other positioning from our systematics, we mentioned this before, and we'll just touch on this once a week. For about the next 3 to 4 weeks, we still won't see any large buying coming in from systematics. And this right now is the same thing we saw back in 2022. Look at where the green and the red are here, over 30, and we are still over 30. So this is a bear market bounce we had in the summer of 2022 before we made new lows into October. We are seeing, again, a higher high compared to what happened in March ahead of the tariffs announcement. But again, the setup is still very risky. It's not what we've seen here back in October of 2023 or 2024, where these dips lead to bigger rallies because we are under 20 and under 10 and down around 10. When we are in this 20 to 30 block, this is much more risky. So again, at this big up move, we have areas to watch, but this will be what we really need to pay attention to. And now on to your levels for the day. We are going to be looking, we'll start with the ES as we always do. And so we are looking for rotational price action today, 59.10 to 58.12, with our pivot at 58.62. If we get over our rotational high, we're going to look for 59.60 to 59.90. Our line in the sand is at 58.94. And then we have a small line in the sand at 58.53. Other key levels that we want to pay attention to today on the ES are going to be 59.47, 59.36 half, 59.12, 58.67, and 58.39 half. And now on to the NASDAQ for you here. As you can see, we are well above our line in the sand, which is below our range expectations. So the business is not likely going to change on the NASDAQ today. We are looking for rotational price action 21,376 to 20,976 with our pivot at 21,177. If we get over our rotational high, we look for 21,575 to 27,690. I'm sorry, 21,696. And then our lower targets will be 20,700 and 20,640. And our line in the sand is below that at 20,630. Some other key levels for you on the NASDAQ today are going to be 21,522, 21,396, 21,321 half, 21,143, and 20,970. And now on to crude. Again, we're just bigger picture balancing between 55 and 64. So we're looking for rotational price action today, 61.74 to 63.24. Our pivot is at 62.49. Our upper targets are 63.99 to 64.44, and our lower targets are 60.54 to 60.99. We do have a couple other key levels for you. If we break our lower levels, our lower rotational, we could look for a downside move to 59.92. That's our key level on the downside. The key level on the upside is 63.61 if we get over our rotational high. And lastly, on to gold. So gold, we are consolidating overall. We made our push to our all-time closing high as we looked for back at the beginning of May. Now we came down to our lower range expectations into the green and then bounced back up to our upper zone where we expected market makers to sell. And so right now we're just looking for rotational price action on gold. We are under VWAP for the morning. For our levels today, we're going to look for 32.92 to 33.51 for rotational. So we're right around that rotational low right now. If we break that, our lower targets are 32.62.4 and 32.44.7. If we hold our rotational low, then we're looking for a move back up to our pivot at 33.20.3. The other key levels for you in between these on the GC current contract will be 3306.2, 3273.5, 3262.1, and 3251.9. And lastly, as we talked about at the beginning of this, we do want to give you a big reminder that you need to treat trading as a job, as your career. Your placing of trades, your prep, your levels, that is all your job function. Your job, though, is to not do something stupid enough to lose your job, to get fired. In this game, getting fired is losing your account, whether that's an eval, your own money, or other people's money if you are managing other people's accounts. And so our number one job is always risk management. That's why we focus on that in all of our charts as well as in our trading. And if you'd be interested in learning how to trade that, we do have courses starting in the fall. You can check out our website. And for those that do sign up for our Discord, you get access to these 4 instruments, our charts. And eventually, coming soon, we will give out our daily levels on Sierra chart for you or from our Sierra chart onto our charts here for you to monitor and see how those change daily and the levels we're actually interacting at. So have a great day, everybody, and be sure to control your risk, and we'll be back again tomorrow.